Have you noticed that investment rates are plummeting and going down? Investments that were once promising a return of 18% have now fallen to something like 10%. Today, I'll tell you what this decline means for your portfolio, why you must avoid panic selling or withdrawal of your funds from an investment like a money market fund, and how you can diversify or shift between funds to secure better returns. Stay tuned. Hi everyone, welcome back to my channel. My name is Miss Wangui Mwithaki, and here we talk about investments and financial empowerment. In short, we are here to empower you. In today's video, we'll be looking at the recent decline in interest rates, especially on an investment like a money market fund, which many of us of late have been investing into. In Kenya, as of 2025, the rates have been going low. Okay? The rates have been going down. So I'll explain what money market funds are. I'll share a few current rates from some funds, discuss how inflation impacts net returns, and cover strategies that will help you protect your investments through things like diversification and fund shifting. If you haven't already, like, subscribe, and turn on notifications so that you're notified and you never miss out on updates on investment trends and financial strategies. So let's start by clarifying what money market funds really are. Money market funds are a low type of risk investment. It's one of the vehicles where investors pool money together, which is then invested in short-term, high-quality securities like treasury bills, commercial paper, and bank deposits. They are designed to provide you, the investor, with stability and liquidity, thus making them a favorite when it comes to things like building an emergency fund and short-term savings. They are popular among low-risk investors because they help you preserve your capital. But as you can see today, they come with their own set of challenges. So let's have a look at what's happening with the interest rates on these funds in Kenya right now. As of February 2025, the interest rates on money market funds in Kenya vary widely. For instance, some offer a daily yield of 15%, which translates to roughly 16% effective annual rate. Others deliver a daily yield of 13% with 15% annual, and on the lower end with rates as low as 3.9% daily. This is to show you, or this is to tell you clearly, that all funds are not the same. Okay? They are not equal. And this disparity affects your overall returns. But there's another factor that you need to consider in Kenya's market inflation. Inflation in Kenya is currently hovering around 9%. So this is to say, if your money market fund earns less than that, especially after accounting for taxes, it simply means your purchasing power is shrinking. For instance, a fund with 10% before tax might only net you about 8% after a 15% withholding tax. You see, that's barely you keeping pace with inflation. In other terms, your money isn't truly growing. It's not growing. Okay? Which brings us to the big question. Are money market funds worth it? Let's try and break that down. You see, despite these challenges, money market funds still have their place. One, they're still the best when it comes to building an emergency fund. And this is because they offer you quick access to your funds or to your money without penalties, which is very essential, especially when it comes to financial emergencies. 2, they are still great for low-risk investors and for those who prioritize capital preservation over high returns. So money market funds provide a safe haven in uncertain markets. And 3, they're still the best when it comes to short-term goals. If you're saving for something specific, for instance, let's say you have a short-term goal of trying to buy a car, money market funds still stand to be the better option, especially when you compare it with something like a traditional normal bank account, okay? However, if you want to boost your returns, of which I'm sure you want to do that, you need to start exploring alternatives, okay? When you explore alternatives, it will help you counteract the lower yields that are coming with a money market fund in moments like this, okay? When the rates are low. So consider diversifying your portfolio, and here are a few alternatives on how you can do that. Get into fixed income funds. Some funds offer a daily yield of around 13%, which might be a better option if you're looking for a slightly higher return without taking on too much risk. You can also diversify by investing in a USD-denominated money market funds, and this is great because they can act as a hedge against local inflation. For instance, a USD money market fund that offers something like 6.3% yield, providing some stability against currency fluctuations. You can also mix it with SACCOs and bonds. Some SACCOs have recently paid off dividends exceeding 60,000 Kenya shillings, and bonds can also provide you with a steady income stream while diversifying your risks. So if you're getting me, or simply what I'm trying to say is, don't rely solely on a money market fund, okay? Don't get me wrong, a money market fund is a useful tool in your investment toolbox, okay? So if you have a toolbox, you can't just have one tool inside. You have several tools. Money market fund is one of the tools. So, in simple terms, a hammer cannot do the work of a screwdriver. So, assuming a money market fund is a hammer, you need to find another investment that can do something different, okay? They all have their advantages and disadvantages. Just don't have one tool in your big toolbox. So a money market fund is not a solution for you entirely, okay? Anyway, before we wrap up, here are some final thoughts. While money market funds in Kenya provide stability and liquidity for you, their declining interest rates, especially when adjusted with inflation and taxes, simply means they might not be the best fast track to building wealth for you. So if that's what you thought, maybe you need to press pause, kanyaga mafuta kidogo, and have a rethink. Sawa? But instead of panicking and withdrawing your funds or pulling out your investments, consider diversifying your portfolio, okay? When it comes to investments, do not ever panic sell, okay? Don't ever sell in a downturn. Don't. Actually, that's the best time for you to even focus on other things. Other investments, I mean. You do that by focusing on other fixed income options. You know, have a look at some of the ones I've mentioned, like a US dollar, dominated funds, and even SACCOs or bonds. So go find out about something like rates also. So all investments come with highs and lows, okay? The same way you were excited when the rates were high, just chill when the rates go low. That's normal for investments. They fluctuate, okay? They cannot be constant every day. Just don't panic sell. Don't withdraw your money, because if you withdraw your money and then the interest rates go up, you see you've lost. Stop focusing on investments that are losing at the moment and start focusing on diversifying and increasing your portfolio, okay? Put your energy into other things. Awesome. Well, let me know which strategy that you're willing to use or start to balance your portfolio that will help you grow financially. Let me know in the comment section. I hope this gets to help someone. If you'd like to see more videos like this, don't forget to like and subscribe, and you'll be notified once we upload another new video. Thank you so much for watching, and see you next time.